Hello, everyone. Welcome back to the Trading Room. I'm Shane Vernier, and this is FOMC Live. Today, we're going to cover Jay Powell's final press conference as the acting Fed chair. I think that we're in for some fireworks today. I don't know what Jay's going to say, but the Fed did come in and they did hold interest rates static, which we all expected. We didn't think that they were going to do anything dramatic on the interest rate front. It was about a 99% chance that rates were held at 3.50 to 3.75. I'm going to go ahead and take a look at that. We're going to look at the actual statement and what changed. I just got a nice little brief from CNBC, so we're going to look at that. It's the actual statement. So there's not really too many ways that CNBC can throw their opinions in and sway what we're thinking. I'm going to go ahead and look through that as well. The big story today, those WTI crude oil up about 7%. I mean, it is an absolute light show out there. There's a lot of reasons to believe we're going back to war here relatively soon, and I'm going to look at that. We were optimistic the other day. We are no longer optimistic. All right, here we go. 1 minute chart, 920 EMA crossover, and right there is a good look at your Euro USD contract. So we're going to go ahead and send that buy signal in. This is our 920 EMA crossover. It's one of my favorite strategies out there. 1 minute chart. We are looking to potentially get a little bit of a bullish move. Now, the way we execute this trade, very simple. Qualifiers RSI beneath 30. That means that we're looking to go ahead and grab this long position. So we took the long. There's our coded indicator that shows up. It flashes gold. The big question is, Shane, where are you going to be shooting for your profit target at? That top of that liquidity sweep ought to do just fine. As far as your stop loss, you can either play it as an extremely tight scalp. I don't recommend that. I like this right down in here. Maybe something beneath that swing low, and then we'll just adjust this up to about a 1-to-1. We have a legitimate chance of hitting this trade. It is volatile out there, though, right now. Anytime Jay Powell's going to speak, well, then you know all bets are off. This should be a pretty good press conference, so I'm excited. I can't wait. Not really because I have anything against Jay Powell particularly. I just don't, I think it's time for a changing of the guard. So we're going to go ahead and see if we can get that. This is an interesting trade, though. We sort of took a buy right there in the middle of this value area. You can see exactly when the market dropped and then the big sell-off, and now we're on the bullish foot, and we're taking a little bit of a draw right now. So we'll wait and see how it pans out. The big thing you always do, risk management, got to be solid, 1 to 3% on any given trade. Right now, we're getting our lunch eaten a little bit. That's all right. We'll wait and see how this works. But we're looking for a nice big bullish move here. I think we could definitely get it. The real question is what's Jay's tone going to be? And I like my stop loss right beneath that swing low, right down there, and that low is right around 116.71. So it's a very tight scalp. Only looking for about 9. Well, we're looking for about 12 pips profit, and we're risking about 13 pips. So even if you lose this one, you're not breaking the bank. Believe me, we can make a lot bigger trades and have. But that one right there, not a bad way to approach the action. If you're interested in some intraday scalping, 920 EMA crossover, check it out on over there at How to Trade Calm on YouTube. We got the full video tutorial. So we got a lot of folks in the room. Good to see everybody back. Kelvin, good to see you, Kelvin. Packham, what's up, Shane? What's up, Packham? How you doing? Eli, when Powell speaks, I get paid. That's fantastic. At least somebody's getting paid. I think Jay Powell is probably going to miss that Federal Reserve paycheck. It's going to be interesting to see what he does after his tenure at the Fed. I got $20, says he dives right into the private sector at a mega bank. That would be what I think. Tina Jane, good to see you. Tina, welcome. Jason Maxon, yo Shane, yo Jay, how you doing? Oil has gone to 104. Tina, I'm reading 106.75 right now on U.S. oil CFD. It is a big move, and I think we're in trouble here with regards to our ceasefire being in serious jeopardy. Out in How to Trade Land, good to see everybody. Andrea Garwal, always a pleasure, Andrea. Ralph H., Bobby Bob. My pleasure being here. I think that we're going to dive into a lot of complex subjects today. We're going to make a few trades and break down some price action. That's really all we can do. We're going to watch Jay Powell in his final presser as Fed chair. Unbelievable. It's the end of an era. Jay's been with us through so much, and not much of it really has been good. All right, here we go. Let's take a look at what's changed in the new Fed statement. What you have right here is a good, solid look at some of the verbiage and what exactly changed. You can see some of it's just semantics. Available, recent indicators, that's just semantics. On average, inflation is elevated, remains somewhat elevated. Inflation is now elevated. That's extremely hawkish for the U.S. dollar, in part reflecting the recent increase in global energy prices. So right there, the Fed's already going to pass the buck to the Iran war. Let's see, uncertainty. Nope. Developments in the Middle East are contributing to a high level of uncertainty about the economic outlook, period. And they crossed all that out. So they're certain now that you got a war going in the supply chain, could be under pressure. Voting for this monetary policy action were Jerome Powell, John C. Williams, Michael Barr, Michelle Bowman, Lisa Cook, Beth's Gone, Kashkari, Lori Logan. So essentially what we have here is they're holding serve. the Fed was not interested in doing anything, and the reason why they weren't interested in doing anything was because it's over. The Fed chief is on his way out. Here's where the U.S. dollar stands. I don't think Jay Powell was interested in maybe hiking interest rates to combat the higher oil prices that are stemming out of the Middle East conflict there. He wanted to just get it over with. And this today, I think that if Jerome, Mr. Powell, if you have any sort of, I won't say class, but I'm not going to be mean, but I think that if you have any sort of dignity, you get in and you get out. I wouldn't drag this press conference out 45 minutes. He's been going almost an hour on these pressers for the last several, just answering questions and doing his word games of saying absolutely nothing. I think he should get in and get out. He should get in, read the statement, take 5 questions, and leave. That's my opinion. I think he should wave to the crowd and say, goodbye, I'm leaving. Now, there's a flip side to that coin. The DOJ has dropped all the investigation against Powell on the Fed headquarters remodeling act. So if they do, basically he said, I'm not leaving as long as I'm under investigation. What was that? The DOJ says, fine, we're going to drop the investigation just to get you out of there. And that's exactly what's happened. So I'm curious to see how Jay handles it. I think that he should be brief. More is less, Jay. More is less. We'll see what he says. All right, here's your good look at your dollar index. Really not much has changed, guys. Very, very tight. Very, very, very tight April. And what has just been a tough month really to trade. It's been a rebound month for stocks, but a lot of these commodities in the USD have been absolutely flatlined. You'll see U.S. oil is the big story for today. We've got an absolutely huge move, really a huge move that's developed of about 7%, 7.25%, and there's no end in sight. So maybe Jerome will say something that will maybe put a lid on the oil market. I don't see it. I think our news cycle is dictating everything. I'm looking at that swing high right there for oil and then this yearly high. So basically, it looks to me like one little thing goes wrong, and we're right back up there to that 120 level in U.S. oil. I mean, we could have all sorts of levels, retracement zones and all that. If I was trading U.S. oil, probably right now, I'd have my 30-minute chart up, and I'd say, okay, what do I need to do to succeed? And the answer basically is buying pullbacks. The problem is the liquidity is going to be leaving this market here in about 3 minutes, so I don't really see the U.S. oil as being a great trade as we roll down the stretch here today. That's for sure. Let me see. Luca, why did you stop your longer form videos? We started putting out the longer form videos over on the Switch Markets YouTube channel. So if you want to see some of what we've been working on lately, the Switch Markets, the YouTube channel, it's got all sorts of videos on there on more along the lines of the tools and the service suite that Switch has. We're talking about getting maybe back to the videos this year on how to trade, but honestly, there's only so many times. There's only so many hours in the day. So we do put out a weekly update. That one came out during the pre-London hours today. You can go ahead and check out our Switch On newsletter. That can get you involved with some trade ideas. But yeah, for right now, Luca, those have been placed firmly on the back burner, and we'll see if we get back to those. But for right this minute, Switch Markets on YouTube. That's where you can find essentially all the new videos that we're putting out. I have a good one dropping. It's on the CME FedWatch Index. That's probably about a 10 or 15-minute video. You might want to check that one out because we're going to need that going into the summer months, and that one's going to drop, I think, a week from Thursday. It's Switch Markets on YouTube, so go ahead and check that out if you want to. Okay, let's look at a few markets here, and then Jay is due to take the stage here in about a minute and a half or so. Gold, I get a lot of questions about gold. Gold is broken this week. We're off about 3.75%, 3.79%. It's a big deal. I mean, gold's way down. We're looking finally maybe to leave this value area that's had us right around 47.50 for quite some time. So I'm looking at 44.02. I would love to buy that. Right now, 44.95, 50% level. I don't really care for it. Silver, this is what we put out on our weekly update. You can see upper value that we've traded inside of a value area throughout April. Lower value essentially is right down there at 70. Upper value, a majority of that trade has been at 80, and the point of control, a lot of business has been done at $75. Now we're sort of testing the lower value area. I'd probably be stepping up and buying 70s as downside support. You can see we also have convergence there on that daily lower Bollinger midpoint. That's for sure. All right, we've only got a few seconds here left. I'm going to go ahead and follow this, this gold trade. What do we have here? This Euro USD trade sort of falling apart here. I'm going to go ahead with this gold. Let's take this down to, say, about a 5-minute chart, and maybe we'll see about doing some intraday scalping here on the gold market. And we're also going to look at maybe a US 30, maybe a US 500 as Jay Powell's talking. So we're going to look at equities. We're going to look at this gold, and then we'll probably be back to the Euro USD. All right, I'm going to go ahead and turn the sound on and see if we get this rolling. Jay Powell is now the man of the hour. I'm curious to see what Jay has to say. I think that he's in an interesting position as a policymaker. I think that if I was him and I was on my way out, I'd make this one short and sweet. I'd say thank you. I want to thank the Academy. I want to thank all of my coworkers, and I'll catch you guys on the flip side. That's what I would say. But we'll see what Jay has to say. Right there, nice topside resistance in spot gold at 45.35. We can go ahead and see if we can get potentially a trade here. It's not a bad sell. No comment. Yeah, I mean, he's not really coming out doing anything. Tardis, good to see you, Tardis. Welcome. This right here, though, would be your trade. Would be your sell limit. Somewhere right up in there. You see we sort of failed up there a couple of times, so it's not the best sell in the world, and the price is pretty much taken off. I see movement. He's fashionably late today. We're live. Should be rocking and rolling. Fashionably late.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy has been expanding at a solid pace. While job gains have remained low, the unemployment rate has been little changed in recent months. Inflation has moved up and is elevated, in part reflecting the recent increase in global energy prices. Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. Developments in the Middle East are contributing to a high level of uncertainty about the economic outlook, and we will remain attentive to risks to both sides of our dual mandate. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand at a brisk pace. In contrast, activity in the housing sector has remained weak. In the labor market, the unemployment rate was 4.3% in March and has changed little in recent months. Job gains have remained low. A good part of the slowing in the pace of the job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. Inflation has moved up recently and is elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 3.5% over the 12 months ending in March, boosted by the significant rise in global oil prices that has resulted from the conflict in the Middle East. Excluding the volatile food and energy categories, core PCE prices rose 3.2% over the 12 months ending in March. This relatively high rate largely reflects the effects of tariffs on prices in the goods sector. Near-term measures of inflation expectations have risen this year, likely because of the substantial rise in oil prices. Most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5 to 3.75%. The economic outlook remains highly uncertain, and the conflict in the Middle East has added to this uncertainty. In the near term, higher energy prices will push up overall inflation. Beyond that, the scope and duration of potential effects on the economy remain unclear, as does the future course of the conflict itself. We will continue to monitor the risks to both sides of our dual mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. This is my last press conference as chair, and I will close with a few thoughts. First, I want to congratulate Kevin Warsh on his advancement out of the Senate Banking Committee this morning. This is an important step forward, and I wish him well as that process continues. The Federal Reserve exists for one fundamental purpose: to foster the economic conditions in which American families and businesses can thrive. Stable prices, a strong job market, and a financial system they can depend on. Every decision we make, whether about interest rates or regulatory and supervisory matters or other issues, is made in service of that purpose. Our decisions reflect the collective judgment of the Board of Governors and the Federal Open Market Committee, colleagues who demonstrate analytical rigor, principled judgment, and a genuine commitment to the public interest. Our collaborative and deliberative process has long reflected a shared commitment to finding common ground in service to our mission. This institution is resilient, capable, and staffed by professionals of extraordinary talent and exceptional dedication. It has been a privilege to serve alongside so many great public servants at the Board of Governors and around the Federal Reserve System. The Fed's work is only as effective as the public's understanding of it, and you, the press, are essential to keeping the public informed about what we do and why. The people we serve benefit from your careful reporting. I welcomed the announcement last Friday by the U.S. Attorney for the District of Columbia that she had closed the criminal investigation. She also noted, however, that she would not hesitate to restart the investigation. Over the weekend, the Department of Justice provided assurances that they will not reopen the investigation unless there's a criminal referral from the Fed's Inspector General. And, absent such a referral, if they do appeal the recent court decision, they would not seek, as part of that appeal, to restart the investigation or send new subpoenas. I've said that I will not leave the board until this investigation is well and truly over, with transparency and finality, and I stand by that. I'm encouraged by recent developments, and I'm watching the remaining steps in this process carefully.
Choppy.
My decisions on these matters will continue to be guided entirely by what I believe is in the best interest of the institution and the people we serve. After my term as chair ends on May 15, I will continue to serve as a governor for a period of time to be determined.
Yeah.
I plan to keep a low profile as a governor. There's only ever one chair of the Federal Reserve Board. When Kevin Warsh is confirmed and sworn in, he will be that chair. Once sworn in as board chair, his new colleagues will elect him to chair the FOMC as well.
Oh.
As I regularly point out from this podium, our success in delivering our goals matters for all Americans. I'm confident that the Fed will continue to do its work with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
Yeah, there's no reason for any questions. There really isn't. That should be it.
Thank you, Mr. Chair. Appreciate the kind words about the press. Often doesn't come from the podium in different places, but appreciate that. Can you talk about what is gone into your decision to remain on the board? What kind of criteria are you weighing, and how long might you stay? Thank you.
He's waiting for the investigation
Sure,
to be
so,
over.
You know, my concern is really about the series of legal attacks on the Fed, which threaten our ability to conduct monetary policy without considering political factors. And I want to note here, this has nothing whatever to do with verbal criticism by elected officials. I've never suggested that such verbal criticism is a problem, and neither has anyone else here. But these legal actions by the administration are unprecedented in our 113-year history, and there are ongoing threats of additional such actions. I worry that these attacks are battering the institution and putting at risk the thing that really matters to the public, which is the ability to conduct monetary policy without taking into consideration political factors.
This is just a chop
It
fest.
is so important for our economy, for the people that we serve, that they can depend over time on a central bank that operates that way, free of political influence. It's part of the absolute foundation of this amazing economy that we have. It's just one of the many reasons why the U.S. economy is the envy of the world. That piece of institutional architecture separates successful countries from unsuccessful countries. It is extremely important, not for the people who work at the Fed at any given time, but for the people that we serve, that the Fed remain able to conduct monetary policy in a way that doesn't get pulled into politics, trying to help or hurt any particular politician or political party. It's critical for the people that we serve. In terms of when I would leave, I will leave when I think it's appropriate to do so. Was that all your questions, or was there?
Well, I just have a follow-up, which is, what would you say to the criticism that by remaining on the board, you're actually taking a political act and denying President Trump the majority of the board, which as president he would have if you left?
Good
I
question.
don't see that at all. And as I mentioned, I'm literally staying because of the actions that have been taken. I had long planned to be retiring, and the things that have happened in the last 3 months have I think left me no choice but to stay until I see them through at least that long. In addition, I don't see how this will interfere. My intention is not to interfere. I was a governor for almost 6 years, and the tradition is at the Fed that governors who understand how difficult the role of chair is, and as a soon-to-be former chair, I do understand how hard it is to get consensus with 19 strong-minded people. You work with the chair. You try to be heard, but also collaborate with the chair and try to support the chair when you can. When you can't, you can't. And I think that's the attitude that people generally take, and that's the attitude that I'll take.
Nick.
Chair Powell, if I could ask about the inflation outlook. In March, you described the standard practice of looking through energy shocks as conditional on inflation expectations staying anchored. Since that meeting, there has been very little progress reopening key energy trade corridors. Can you help us understand how the inflation outlook has changed in the intermeeting period, beginning with the prospects for tariff pass-through resolving on the timeline that you had outlined in March, before getting to the energy shock that is now on top?
So, I would look at it this way. For a long time, we've been working on the hypothesis, really, that tariffs would lead to a one-time price increase and that would go away over time. In other words, that there would be no further change, so measured inflation wouldn't reflect that higher level going up more and more. And it's time for that to happen. We really do expect that to be happening in the next 2 quarters. So we'll be watching very carefully to see that what we've thought all along would happen. That's the kind of critical part of the forecast. We need to really see that. With energy, it's so hard to say. I mentioned, in sort of the textbook, you would look through an oil shock because they tend to be short-lived and they tend to revert, and monetary policy works with long and variable lags, so you wouldn't necessarily react right away. I think that is all the more true given that we're several years above 2% inflation and that we're already looking through the tariff shock. So I think we're going to be very cautious about that. But the question about looking through energy really is not in front of us right now. It hasn't even peaked yet. And I think we'd want to see the backside of that and progress on tariffs before we even thought about reducing rates.
So if I could follow up, the statement today preserves language that has taken on some meaning as it was socialized when the committee was actively lowering rates. Why is that easing bias still ripe, given how different the inflation outlook is now versus a meeting or two ago? And what more would have to happen for it to get evicted?
So that was, as you will recall, we had a discussion about that at the last meeting, and we talked about it in the press conference after the March meeting. We had the same today. We had quite a vigorous discussion about that very issue and the guidance, and is it still appropriate, and that kind of thing. And I would say that the number of people on the committee who either could support that language changing to a more neutral stance so that a hike is as likely as a cut. That number has increased over the intermeeting period, and it's easy to see why. I mean, it's a good question, right? You see, inflation has moved up over the interim a bit. Core inflation's 3.2 now, moving, albeit just a little bit, in the wrong direction. And we know that there will be, that there's headline inflation coming out of the Gulf, and we don't know how much that will be. We're going to need to see. So it makes all the sense in the world that people would look at that and we'd have a vigorous discussion about that. You saw that 3 people dissented over the language. I think all of those people agreed with the rate decision. So the majority of the committee did not want to do that, and I didn't think we needed to do it at this meeting. It really was just a question of why do we need to do that now? You know, we have so much to learn. There's so much uncertainty about the path ahead. There doesn't need to be any rush to make that decision now, because, you know, what happens in the next 30, 60 days, even by the next meeting, could really change the picture around that language. So, you know, it's a much closer thing on the committee than it was in March. You know, that makes all the sense in the world, it seems to me.
Claire.
So Claire Jones, Financial Times. Just going back to this issue of the easing bias. We've now got oil approaching $120 a barrel when it comes to the benchmark Brent crude. If it stays around those levels 6 weeks from now, what would be your best guess as to whether the easing bias will still be in the statement? Thank you.
I wouldn't want to guess. You know, well, first of all, we're going to have new leadership in all likelihood by then, and new leadership's going to have a very important role to play in that. So I won't be standing here at this podium to answer your question.
It's
so,
not my problem.
That's
the next guy's
as I
problem.
mentioned, that's all I can really say is that we had a great discussion about that today.
Powell was drinking before this one. Had a few martinis at lunch, didn't you, Jay?
The majority are still on the page of not feeling the need to move to that level, and that's where I am. I get it, though. You know, at a certain point, you would move, and that conceivably could come as soon as the next meeting.
Thank you. Just to follow
Wouldn't
on,
want to pull back by here in
leadership
U.S. oil, a little
also
scalp.
rather lukewarm on press conferences and on the dot plots. What would your advice to him be on these communication tools?
So I'm not going to give him any advice through you today here, but I think communications generally is. I think every incoming chair takes a look at communications, and it's a very healthy thing. I mean, communications it's very complex, and you know, you can always be looking at new things. And if that happens, it feels like it's going to happen. That's a completely appropriate thing.
Neil.
Hi, Chair Powell, Neil Nolan with Axios.
Look at that 4-hour
Can you tell
sell.
us if you've been in touch with incoming Chairman Warsh.
All right, here we go.
To what extent is this a normal transition process versus all the things swirling around, something unusual, and what can we expect when he takes that podium in a few weeks?
I haven't seen him since seeing him at a dinner in January where I congratulated him and had a nice chat with him. Haven't seen him. I don't know what a normal process is. You know, the last process was with Janet Yellen, with whom I had worked for 6 years, and so it was, you know, we were sitting down the hall from each other, so it was a very different thing. I think this is and will be a very normal, standard kind of a transition process. So that's what I expect. I have every reason to think it will be.
Quick follow-up: is the Supreme Court ruling on Governor Cook a factor in when you may leave as a governor?
I wasn't thinking of it as such, but no, not really. I mean, I'm thinking more of the other things I mentioned.
Chris.
Hi, thanks for taking our question. I wanted to ask a question about your tenure, and Chris Rugaber at Associated Press. During your tenure as chair, you often spoke about how disadvantaged Americans benefited from extended periods of low unemployment. In the new framework the Fed adopted in 2020, some economists say elevated the Fed's employment mandate. Are you worried that the pandemic inflation spike that followed will make future Fed chairs more reluctant to pursue a hot jobs market, and should they be?
I don't know the answer to that. I mean, what we experienced in the teens, the mid-teens, was really low levels of unemployment for a long period of time and no reaction from inflation. And we all very much took notice of that. We also noticed that.
All right, there's our scalp. Let's see how this one goes.
We're going to people at the bottom end of the income spectrum.
Market's
And
under
we had
pressure,
many
that's for sure.
reports I mean, it felt like a fairly stable equilibrium, and a lot of benefits were flowing to people at the bottom end of the income spectrum, including companies were
going negative.
Setting up in
big level right
in,
there. 107.
People who were confined.
See if we get a bounce.
Like training them before they got out, and it was a very healthy sort of set of societal dynamics. So of course, I think anybody would love to get back to that. I don't think that anything that happened to create the global pandemic inflation was in any way related to overweighting the employment market. I mean, it was a global shock.
A little bit negative. The
that
fight's at
happened
107 right
essentially
now,
very, very
WTI.
similarly all over the world. It had to do with closing, reopening, stimulus, and all that. And I mean, you could look at a graph of 10 big economies on the page and not know which was the U.S. and which was Germany, France, and things like that. So
92.
I don't think that insight
See if we
was
get a
in any way
bounce.
responsible for the high inflation that we experienced.
Just really slow.
I mean, I think it's always been a balance. You've got to be strong on both of our dual mandates, and for example, now we don't feel that the labor market is at all a source of inflation, so we don't need to be worrying about that. It's been a long time since we have had to worry about that. Well, actually, during the pandemic recovery, the labor market was super overheated and tight, and that's when we had to worry about it, but not now.
Just on the other issue, do you need more assurance from the Justice Department before stepping down? Is that what you're waiting for?
Yeah, he wants him to drop everything.
I'm waiting, for the investigation to be well and truly over with finality and transparency, and I'm waiting for that.
Wait until I'm
And
off
I
the
will
hook,
leave
and then I'll
when I
leave.
think it's appropriate.
I'm not going to
do
let
so.
him light me up as a civilian. That's exactly what he's doing. He's staying on the FOMC to protect himself. He's not going to be a civilian with the federal government after him. Are you
I'd
crazy?
like to ask you if you could explain a little more or characterize a little more the discussion about
Interesting.
the two-sided view and interest rates, because there were some members of the Open Market Committee who've been suggesting that we may need to raise interest rates even absent the war because inflation was not coming down fast enough. Is there any sense that interest rates might have to go up, or was this just a setup to sort of warn people that you're worried about the war impacts?
Very slow. Everything's very slow here.
The three dissenters and others who could have supported that, and others who were voters and non-voters who preferred it, they all supported the rate decision, right? So people are not saying we need to hike now. It's more a question of, don't we kind of feel that we should be neutral? And what are markets doing? People argue that this is consistent with markets are doing. And again, it's a very fair question, but these changes, there is it's a form of forward guidance, and you want to make them in a way that will be sustained and continue to make sense, and not something you need to take back fairly quickly. So I think a group of us, including me, didn't feel like we needed to be in a hurry on that markets are not confused about our reaction function. We don't have a problem to solve on that. But the other side of the argument is a good argument too, as I mentioned. It's a perfectly good argument to be having, good discussion to be having. So, and it came out the way it came out.
Well, you've got three dissents in favor of two-sided warning. You've got yourself staying on the board. You've got the criticism that does come from elected officials, and you've got a lot of critics who have faulted the Fed for being too slow 2021 with inflation. Are you worried about Fed credibility under all of this? Is that one reason that you want to stay on?
Not driving my thinking now. I mean, monetary policy is going to get made by 19 people. There's a lot of stability there. I mean, if you think about it, every new Fed chair has the same situation, which is you've got 18 colleagues on the FOMC, 11 of them vote during any year, and your job is to create consensus. It's to talk to them, understand them, be inside their thinking.
Pretty good level
and
right
be able to
there.
pull them
Dollar
together
CAD resistance.
and get consensus.
That's not a bad
and
one.
move. And that's what every Fed chair has to do. And I think Kevin Warsh is actually quite well. He has the capabilities, skills to be.
Crude
to be
oil
very good
trades
at
up
that,
back,
think.
I guess.
So I think I'm not so worried about that process. I think that'll work itself out.
He's more worried about his legal problems.
Howard.
Thank you, Chair Powell. Howard Schneider with Reuters. You mentioned that staying on as a governor, you intend to keep a low profile. I'm just wondering if you could give us a little more detail on what that looks like and how you can. Touche. Walk down the steps. What that looks like, and particularly around the policy discussion, how you're able to have your intervention.
Going
and not
bullish
be
now?
A shadow chair and not have a kind of an outsized influence over the process.
Yeah, that's just something I would never do. The shadow chair thing. No, I don't know what the exact specifics of it will be, but I'm going back to being a governor. I respect the role of chair. I was a chair. I was a governor for 6 years, and I know what that's like. I know it, and I had a pretty front row seat particularly with Chair Yellen, to whom I was close when I worked with Chairman Bernanke for 2 years, but. I was brand new at that time, so I got a sense of what it was, and I had real sympathy for how hard it is to get that group to consensus. And I always felt like I don't want to add to that unnecessarily, and that means try to support the chairs where the direction the chair wants to go, and if you can. If you can't, you can't. And I think that's the way it's always worked there, because the chair only has one vote, plus the ability to develop consensus. And if people won't be. They won't, if they're not flexible at all, then how do you ever do that? And so that's why the authority the chair has really is to develop relationships with people and work with them, and then put something forward that has consensus. And I propose to be a very constructive participant in that process, really out of respect for the office of the chair.
And in your view as a soon-to-be governor, how do you see the risks of oil prices bleeding into core inflation in coming weeks? Because it seems like the commentary that was coming from particularly some of the Reserve Bank presidents, they were elevated concerns about the bleed into core. And, here we are with 3 dissents now. What do you see as the prospect of a core inflation?
Those prospects are real. Remember, though, and they're real, and the real thing is we're going to have to wait and see. We're going to need to see. And the good news is we think our policy stance is in a very good place for us to wait and see. We're right kind of at the high end of neutral or perhaps mildly restrictive. The labor market shows more and more signs of stability, whereas inflation is kind of misbehaving. And so maybe a little bit of restriction or the high end of neutral is just the right place to be. So we can wait here and see how things work out before we act. And we'll see how much how much does come through into core. You see it already in airfares, of course, but you may see it in many other places. We just don't know yet, and it's so unknowable, because how long will the strait be closed? You can develop any number of scenarios that you want, but we really won't know until we know. So fortunately, we're in a good place to wait and let things develop.
Thanks, Mr. Chairman. You started holding post-meeting press conferences for every meeting as opposed to the ones with with SEPs. Can you talk about why you see that as a net positive?
So we always said, when we were doing quarterly press conferences, we always said we can move at any meeting, but we only ever moved at the quarterly SEP meetings where we had the press conference. So if you think about it, during the pandemic, we were moving like a lot at every meeting and sometimes between meetings, and doing that without a press conference, I think, would have been quite challenging. It's become the industry norm. It's the standard. I don't know whether that has to remain that way. I don't know. I mean, it's just something people have become used to, and I do think it's quite helpful to I try to deliver a message on behalf of the committee, rather than 18 other people going out and delivering their message, and it's going to be all over the place, because we do thankfully have.
Man, this is just brutal trading, guys. I mean, there's nothing here.
Thanks. The other
This
thing
is
I wanted
just
to
a-
ask
this
about
is
was the
garbage.
communications review from last year. Could you describe the debate last year? What changes were considered, what you wanted, and what prevented action, any action on those changes?
So yeah, I'm not going to go into the real small specifics, but what we found very quickly was that making changes, making really large changes, for example, to the dot plot or the SEP, it
Dollar
didn't have-
yen.
we couldn't come up with anything that had really broad support on the committee. And so we just moved on. We didn't really do as much on that as we might have. And I was never the world's biggest fan of the dot plot, but you can't beat something with nothing. And we've looked at a bunch of things, and it's something. Like I said, I think every new chair is going to look at our suite of communications, and think about what would be changes. We are the only major central bank that doesn't publish a forecast, And that's because we have a 19-person committee, and you try to do that at the board. That's hard. At the committee, that's hard. It's hard if you do it at the staff. So it works. I think our communications are fine, but looking at doing it in a different and better way is the most natural thing in the world.
Thank you. Colby Smith with the
No
New York
Phil,
Times.
huh?
If I could follow up on Mike's question about hikes, are we right to assume that the hawkish outcome for the Fed is still one in which the committee just extends the pause in rate cuts? And to what extent is there a growing sense within the committee that monetary policy really isn't just restrictive at all right now? The economy is holding up relatively well despite this major energy shock. The unemployment rate has ticked lower. Inflation was moving sideways even before the war and is now moving higher. So where is the committee at on that debate?
Where we're at is we think our policy rate is in a good place. If we need to hike, we will certainly signal that, and we will certainly do it. And if we need to cut, then, or if it's appropriate to cut, then we'll signal the opposite. I think because we feel like we're in a good place to move in either direction. Nobody's calling for a hike right now, so it really is going to depend on how things evolve, and that's really where it is. As I mentioned, much closer question this cycle on changing the guidance, but ultimately we didn't.
And as it relates to the war, at what point do you think the risk to growth will be larger than the risk to inflation as this conflict drags on?
You just have to find that out empirically. Given our the fact that we're a big exporter of energy, and that our economy is far less energy intensive, oil intensive than it was during the 70s, the effects on the United States are really substantially less than those of Western Europe or Asia, who are feeling much greater effects from these things. The effects we're feeling in the current situation currently, and in sort of what's priced in, which is a relatively quick outcome. If this goes on for much longer and prices go much higher, then we'll feel that much more. And of course, I'm talking about aggregate inflation numbers. We're very well aware that people are experiencing higher gas prices all over the country now, and that hurts. And those hikes may continue to happen. And other things are going to start to reflect airline fares I mentioned, and other products and services that are dependent upon petroleum and derivatives of petroleum. People are going to start to feel that.
Edward.
Thank you, Chair Powell. Edward Lawrence with Fox Business. So I guess I'll just ask you directly on this. The markets don't see a rate cut at all this year, is what they're predicting. Do you think that we are at the neutral rate? Why or why not?
The neutral rate is we cannot know it with certainty. I think pretty close to the neutral rate. Yeah, I always had it between 3% and 4%. We're a little north of 3.5%. So that's well in the range of what I would consider a reasonable, but at the higher end of the range of what I would consider reasonable neutral rate. I think the labor market is still probably cooling off just a little bit, and I don't think there's much of a case for any case really for policy looking meaningfully restrictive, maybe mildly restrictive or neutral, I would say.
And I want to follow up on some of the other questions about your future a little bit. The first time we've seen 4 dissents now since October of 1992. Are you handing off a divided Fed?
Good question.
The thing to remember is we have always had vigorous debates, and they're excellent debates. I have to say they've been really good, and we're in an unusually difficult situation. So we've really had 4 supply shocks. You can say more than 4, but at a minimum, we had the pandemic, we had the invasion of Ukraine, we had tariffs, and now we have Iran and the oil, the oil spike. So every supply shock has the capability of driving inflation up and unemployment up. And what do? The central bank has a really hard time knowing what to do. So the right thing to do is to try to balance the achievement of those 2 goals, and that's what our framework calls for us to do. But these are really tough difficult judgments. You've got to have a forecast for each variable. You've got to think how long it's going to take to get back to target. You got to think how restrictive or not is policy. So it's only natural that you have a range of views on the committee. You know, people are going to see it different ways. They're going to have different risk tolerances and that kind of thing. I mean, if everybody agreed, that would be surprising. I think it's only
U.S. oil
it's partly a
explodes after a
function
deep
of
draw.
the extraordinarily challenging set of supply shocks that we've been dealing with now for 5-6 years.
Let's shoot for a little bit more.
Thank you so much, Chair Powell. Selena Wayne with ABC News. Are you confident that Kevin Warsh will stand up to political pressure from President Trump?
So he testified very strongly to that effect in his hearing, and I'll take him at his word.
And when it comes to gas, right now it's over $4 a gallon. Inflation just hit a 2-year high. Should Americans expect to be paying higher gas prices for the rest of this year? And in your view,
For the rest
does
of our
that take
lives.
a rate cut off of the table? And
I gotta
secondly,
sell the
by
truck.
staying on as Fed governor, what message do you think you're sending to the president?
I don't know what gas prices are going to do for the rest of the year.
I do.
It will depend on how long the strait remains closed and how
Ask me.
quickly it can be reopened and that kind of thing.
Going up.
But remember, when gas prices go up, that's disposable income coming out of people's pockets, so they're going to spend less on other things. So there will be a hit to GDP. So it's a question whether spending goes down
No
to
fill up
offset
there. That's a
the
bummer.
inflationary effects. So it's not the answer isn't obvious ex ante.
These are
whether
really
you-
tough
whether you
markets,
should move your
guys.
rate
I mean, these are really tough.
because of that. We'll have to see
Look
how
at
it
this.
evolves.
This missed. I mean, it's just, this is ugly.
I'll stand on what I said earlier.
Really ugly.
Victoria.
Hi, Victoria Guido with Politico. During your tenure, Fed independence has come under pressure in a lot of different ways. And I was just wondering, practically speaking, where do you see Fed independence as coming from? Is it the law? Is it political support from Congress? Is it the actions of the Fed? What sustains Fed independence?
Well, it's to a significant extent, it is the law. And, we've had to go to court to successfully so far to defend it. But the law does create a setting in which the Fed can and is directed to make monetary policy without consideration of political factors. And so part of it is the law. But it goes beyond that, though. There's a set of customs. There's a boundary line between the Fed and the administration, between the Fed and the Treasury Department. And we need to continue to respect those boundaries about what the Fed is responsible for and what the Treasury is responsible for and what the rest of the administration is responsible for. So some of it is legal. In fact, it's all legal at the end of the day, but it's more than just monetary policy. We don't want to use our tools we haven't wanted to use our tools to achieve goals that are really clearly outside our mandate. Every administration looks at our tools and thinks that would be good to repurpose those to serve other purposes, but that's dragging us into politics and into fiscal policy. So we've resisted that.
Well, and maybe another way of asking it, too, is do you think that Fed independence is as strong now as when you became chair? And if so, why?
Look, I think it's at risk. I mean, I think these legal assaults, if you will, as I mentioned, the institution is being battered over
You're
these
$2
things.
billion
We're having to resort
over on your budget
the
to build
courts
one building.
To enforce our legal,
One building.
It's not so much.
They built the
independence,
Louisiana
it's
Superdome for
really
less than that.
The ability to.
Where'd the
do
money go?
to make monetary policy without
Simple
political
question.
considerations.
Where'd the money go?
That's what we're talking about, and.
A
we've had to
$2
do
billion
that, and we've been
overrun
successful so far,
on one
but
building.
That's not over. None of
$2
that is
billion in the
concluded
budget,
yet.
10-year
And
overrun.
It's really
Give me a
important.
break.
It's not about people who work at the Fed or the institution. It's about the benefits of a central bank that makes decisions based on analysis and our best thinking, rather than trying to help or hurt politicians. It's that there's a bright line between central banks who do one and do the other, and successful countries have uniformly, successful advanced economy countries have a really strong set of protections around their central bank just for that reason. So that's what it's all about. I think I am confident, as I said in my remarks, that the Fed will continue to make its decision based on analysis, rigorous analysis, and not on political considerations. But we've had to fight for it.
The original budget was $1.4 billion. Now they're exceeding $3 billion. They want to know where the money went, Jerome.
What the law says.
They want to know where the money went,
which is to, let the Fed do our thing.
I want to know where the money went.
It's an institution full of human beings who work super hard to get things right for the benefit of the public. We're all human. Don't expect perfection.
Can't play dumb there. Where'd the money go?
Decisions without political considerations and the very best analysis we can bring.
Katerina Saraiva, Bloomberg News. How would you characterize what you've heard from your colleagues on your decision to stay? Do you have their support? And then have you heard concern from your colleagues about continued legal attacks from the executive branch? Is this something that others have, talked to you about?
So I think that I don't want to report on what my colleagues think. They can speak for themselves. But there are widespread concerns that these things may continue. That's all I'll say. And and that would be a problem. And so.
And then I just also wanted to ask about Governor Waller's speech on the reserve banks. Do you have any thoughts on centralizing some of those functions in the way he described? And then are you concerned that something like that could potentially be a slippery slope to to consolidate reserve bank functions even more in such a way where the central bank ultimately loses some of that important regional information?
So we try to be good stewards of the public's money and efficient, and Chris Waller is particularly passionate about that. Of course, so are the reserves, so are the presidents, and it's a question of how do you accomplish it. We of course, and Chris said this in his speech, we want 12 strong independent central banks with their own staffs and their own monetary policy views and all that. But there are things that are done in all 12 which could well be done at one much more efficiently and with cost savings. And so there's a back and forth going on that. But everybody's on the same page. The other thing he touched on was the idea of removing reserve bank presidents from office over different views on monetary policy. And I would just agree with him so strongly that would be the beginning of the end of the Fed's ability to make monetary policy independently. If every administration could come in and do that, you're just another cabinet agency at that point. So that's not something that I would support. Chris said the same thing.
Christine. Thanks, Chair Powell. Christine Romans, NBC News. I want to ask about legacy. When the history books are written, how do you think your stewardship at the Fed will be remembered for the past 8 years?
I'm going to just say that that's for someone else to say. I'll give you a mulligan on that.
All right, I'm going to ask you about misbehaving inflation then. You talked about those 4 big shocks, supply shocks over the past 5 years, and inflation still misbehaving. What's your message to American families who feel like inflation has not been under control for them really since the COVID reopening?
We're committed to bring inflation back down to 2% and sustainably. That's our goal, and we'll stick at it until that happens. We keep getting these events keep happening, which keep driving up costs, and the best thing we can do is to use our tools to guide inflation back down to 2%. I think trying to get there really quickly could be very costly in terms of job loss and things like that, but we try to get there over time in a way that does the least damage possible, and our commitment to that is never ending and unshakable.
Yeah, but the half-point rate cut in 2024 is the mistake, Jay. You know that. That was a bad one. Fall of 2024, half-point rate cut. Why?
I don't know that you can be awfully resilient. So it's actually quite resilient, I would say, because it's a positive.
He's passing the
buck. If I can have that amendment. Yeah,
it's been a tough run, though.
Growth is really solid across our economy. Some of that is that consumer spending is hanging in pretty well. The most recent data are good. And some of it is just the apparently insatiable demand for data centers all over the United States. So a lot of business investment going into building data centers, and every reason to think that that continues. So you've got an economy that's growing at 2% or better.
Coming off,
which
coming
is
off.
private domestic final purchases, which is really a better signal of a momentum in the economy, is actually higher than that. So that's a positive thing. If you look at the unemployment rate, it's 4.3%. So that's a low rate. That's pretty close to mainstream estimates of the natural rate. We've been there for a long time. So it doesn't feel like a good labor market to some who don't have jobs, because quits are really low, hires are really low, and there's effectively no new net job creation. So that's in a sense, the labor market is in balance, but it's an unusual and uncomfortable kind of a balance where people who don't have jobs will have a hard time breaking in unless somebody quits their job. So that's pretty good. Inflation is the thing we need to work on, and it's partly tariffs, which we think that inflation should subside over the course of this year, because it's kind of a one-time increase. It shouldn't be repeated, and that should start happening pretty soon. The energy inflation that we're getting should go through fairly quickly, and we'll just have to see how that works out. In the meantime, we think our policy stance is in a good place for us to hold and wait developments.
Jennifer. Thank you, Chair Powell.
Wow.
Jennifer Schonberg.
Everybody
Yahoo
gets a
Finance.
question
At the
today.
risk of beating the dead horse here, clearly
Going
three
way too
members
long with
objected
this.
to keeping that easing bias in the statement. And you said that the majority still
Oh,
didn't
Yen
need,
scalp's outta here.
Still didn't need to move to new language at this point. So does the majority of the committee still have a bias towards cuts at this point, or has the bias on the committee shifted away from cuts towards holding or hikes if that was needed?
So I think that the center is moving toward a more neutral place, and that's sort of what markets are saying too. I just think there's a lot of signaling going on when you change guidance like that, and so we just, I guess a majority of us didn't feel like we needed to send a signal on that right now, but maybe it'll come to that, and the reason is because we're kind of waiting to see what happens with events in the Middle East and what are the implications of those events for the U.S. economy. So there's a group who feels like we don't need to be in a hurry to do that. We get it, and of course we will move to a hiking bias if we want to hike, and we'll move to a neutral bias before that. But there was a difference over whether to do it at this meeting, at a meeting at which all but one of us agreed that the rate decision was correct, which was not to move.
And you just said moments ago that you believe Fed independence is at risk. Is it safe to say that you want to stay on as a governor to serve as a check and balance on that?
I want to stay until I will stay until I feel it's appropriate for me to leave. And yes, that is really what is driving this. I'm not looking to be, a high profile dissident or anything like that. I'm more looking at the other aspects of this and wanting to see that things have calmed down and we're returning to a traditional model of working with the people that you have and bringing them to consensus and respecting that consensus. That's what I'm hoping to see.
A little bit of a break here in crude oil
Matt Egan.
for the last one. They
Thanks,
got to
Chair
wrap
Powell.
this
Matt
up.
Egan, CNN. You've made many tough decisions in your time at the Fed, and as your time as chair comes to a close and you think about your tenure and perhaps your legacy, are there any decisions that stand out as ones that you're particularly proud of? And are there any that, with the benefit of hindsight, you would take a mulligan on?
Yeah, it's hard. I wouldn't want to single out individual things at this point. I'll just say, all of us together have consistently tried to do what we think is best for the American people based on our tools and our objectives that Congress has given us. It's been very challenging because we've been in a situation.
That's right,
of supply
Eli.
shock,
Definitely not action.
Supply shocks really for 6 years, and that's just a very different situation than for a very long time. What the Fed and other central banks were doing all the time was demand management, and there was always the inflation mandate, but inflation was low for 25 years. So this is a very different world and a much more challenging one where you have to balance the two objectives. And by the way, central banks that have an inflation mandate have to do exactly the same thing because they're balancing economic activity. So that's been challenging, and we've tried to do our very best through these really challenging times, and I'm really proud of the work that I've done, that my colleagues and I have done during these years.
They're not leaving anything for the
To follow up on
memoir.
some of the discussion around Fed independence, can you explain to the public why this notion of Fed independence, which might sound kind of wonky to some, is so critical?
Explain that rate cut right there to the public. Explain that one. If inflation's persistent with all these supply shocks and tariffs and all that stuff, that one right before the election. Explain that one.
Every major
That's what I want to hear about.
Advanced economy in the world has made the same decision the United States has made, and that is that they want to take the making of monetary policy, the setting of interest rates to support the economy, to achieve maximum employment and price stability. They want to take that out of the direct control of elected politicians. And the reason is elected politicians are always running for election, and they'll always want low rates, and that will lead to inflation over time. So after literally centuries of experience with that, the whole world moved to the different model, and it's worked great. I mean, this is the era in which inflation was under control for 40 years. Then we had the pandemic, inflation everywhere in the world, and now we have inflation that had gone pretty much all the way back to target, really close to all the way back to target, and now is being buffeted by the energy shock, and the U.S. buffeted by the tariff shock as well. So, but what I would say to the general public is that's the backstory, is that don't think about an institution being independent. Think about it this way, that you want people to make monetary policy and set interest rates to benefit the general public and to try to achieve economic goals, which are maximum employment and price stability, and focus only on that and ignore political considerations completely. Ignore them. This isn't bipartisan. This is nonpartisan. So we want to just work directly for the American people doing these things. We don't think, I want to do this because the president says it's a good idea, or because there's an election coming up and I want to speed up or slow down the economy. I mean, think about that. If that's what we were doing, we'd have no credibility. Markets would lose faith in us, and our ability to control inflation and have any respect would be gone.
Well, we hung in the U.S. oil trade and it panned out. Got pretty sticky, but
that we will produce 2% inflation.
paid
If
us
you look
off.
at longer run expectations, markets believe that there's no sense in which our
really
credibility
tight,
in the
choppy
markets has weakened.
conditions.
It's just not the
This
case.
is brutal
It's
trading.
People do
Brutal.
get it, that this is our commitment and that we will achieve it, and it's priced in. If you disagree with that, then you can go ahead and bet against the markets, but the markets are pricing in Fed credibility.
Yeah, I mean, Irish, you're absolutely right. They've got to shut this down. There's no reason for this.
Richard Escobedo with CBS News.
Take a bow and get
we
out of
talked
there.
A lot about gasoline prices and even you mentioned airline ticket prices, both of which are up dramatically because of the war in Iran. And so I wonder, are you seeing that weigh down consumer spending in other parts of the economy? And if so, how worried are you that will be a drag on growth?
You don't see it in spending yet. You really don't. I mean, as one of your colleagues said, the economy has been resilient. It really has. Not just this time, but it's been remarkably resilient for some years now. The U.S. economy has just powered through shock after shock, and consumers are still spending, and that's what the banks will tell you, credit card companies will tell you, the retail sales numbers that we got most recently. People are still
but is the spending
and,
a function of inflation?
how long
Are they
can that
spending
go
more
on
because
in a
things
world
cost
where
more?
If gas prices were to go up a bunch more, that's taking otherwise spendable money out of people's pockets. But right now, we don't actually see much slowdown yet, certainly none from this. But you think logically you will, because people have a certain amount of money to spend. If they're spending 25% more on gas or something like that, then that's going to come out of other spending. But we don't see it yet.
One last thing. You mentioned those economies in Southeast Asia that are particularly dependent on petroleum. They make a lot of the stuff that American consumers buy. So was there any discussion today about whether or not those costs getting passed along to consumers is a real concern, and whether or not that might push up inflation?
So all of those things are in the models that we use to calculate inflation. So they're just parts You can ask about anything like that, and they have a place. The staff has a place where they're looking at that and pricing in what will happen with higher prices and that kind of thing. So it's there. The effects are not that big yet. We're a huge economy. The import sector is only 10% of the economy, so we're not like a European country where 50% of the GDP is in the external sector. We're also, as I mentioned, we're an oil exporter, so we're not feeling the same kind of pain, and we're not likely to feel the same kind of pain that economies in Western Europe and certainly in Asia are feeling. Anyway, thank you very much, everyone. I won't see you next time.
Well, there you have it. That's the end of an era there. Jay Powell officially finishing up his tenure at the United States Federal Reserve. A couple of things we learned. Number one, Jay is going to stay on as a Federal Reserve governor. That is a surprise to me. I thought that he was going to be happy trails and on down the line, but clearly it's a legal move. No question about it. It's a much better position to be a Federal Reserve governor than be a civilian if the DOJ reserves the right to investigate you at the drop of a hat. So that right there is going to be big. I showed you the statistics. They're over budget by over $1 billion on those estimates. And listen, cost overruns are just a part of construction. I was in the industry for a long time. It seems like it was always the case where, well, we're going to run a little bit long, or maybe we're not quite on the timetable. But this, you're running into a decade. You're running over $1 billion long. I mean, clearly there's some shenanigans going on there. Now, it might not be Jay Powell. It might be the contractors. Who knows? Who knows what's going on there? But what we do know is this. He's going to stay on as a governor to protect himself legally. I guarantee it. That was his thoughts. I guess I could go into the private sector, but then I'm really vulnerable for prosecution. Maybe. That suggests that maybe there was some shenanigans going on. I figured that it was a political move to pressure the Fed to cut interest rates and pressure Jay Powell to get on down the line. But it looks like there may be some real investigations, and there's been a lot of indictments here lately at the Southern Poverty Law Center. They got a big indictment that came down. Comey was indicted yesterday. There's supposed to be a bunch of indictments coming out. Now, whether any of them are legitimate and they stick, I have no idea. I'm not in those rooms. But what I do know is Jay Powell is going to stay on to protect himself. And so we understand that now. Now, as far as Warsh goes, Warsh is supposed to be a rate cut guy. We are going to see how fast they can get the game back under control and get those interest rate cuts headed our way. To me, I don't see how you're going to be able to cut rates in this environment. U.S. oil is trending up above 107.50 right now. The U.S. dollar is a little bit stronger. I mean, it looks to me like that ceasefire could be in danger. This is just a couple news stories that we wanted to cover here. The blockade, we're saying the blockade may be extended. Trump threatens Iran to get smart soon or else. That's one of the things. And the other thing is the UAE left OPEC yesterday, and that was really a big move. The United Arab Emirates were in OPEC for 59 years. So all of a sudden that cartel, that OPEC cartel, it took a major blow without the UAE nations in there. Is that the reason why crude oil is driving a little bit higher today? I would say that it's certainly a part of it. And the other part was that, you had a 6 million barrel draw here in the United States on domestic supply today. Once again, I don't think that's going to drive crude oil up 7%. But what I would say is that the global energy dynamic is very tenuous. Talked a lot about that since we got back in the saddle last week off of vacation. I said, hey, listen, 95 is sort of the line in the sand, and anything above 95, you're just waiting for that right news story to drive prices through the roof. And that's exactly what we've seen. You've got the UAE leaving OPEC. That provides some uncertainty there. You've got sort of shrinking domestic supply here in the United States, which I think that's a peripheral metric or a factor at best. But then we've got fresh saber rattling out of the White House. Iran better get smart soon, whatever that means. But it feels to me like we're going into the next phase of the Iran war. And I was optimistic we might get a peace deal out of this. I don't think we are. I mean, judging by your crude oil, there's an old saying, show me the chart, I'll tell you the news. 107.50 means you're probably going back to war. I mean, we're talking about at the drop of a hat, we could be at 125. It's absolutely incredible. So that was the last press conference for Jerome Powell. The key takeaway is that he's going to stay on as a governor, and the DOJ has suspended the investigations for right this minute. Warsh looks like he's going to be coming in, and we'll be dealing with Kevin Warsh from here on out. I'm curious to see if they keep the monthly or the meeting by meeting press conferences. They might go back to a quarterly, which isn't necessarily a bad thing. Today was an absolute exercise in futility. I mean, there was nothing for Jay Powell to say, and for that thing to go on for an hour and let everybody ask questions that really meant nothing, To me, it was just a waste of time. So I appreciate you guys joining. You saw firsthand how difficult trading in this whipsaw, choppy, flat environment is. We were fortunate. We let the U.S. oil trade bleed against us, and then it went up and got our profit target right around 107.50. It's trading 107.55 now, it was too hard of a trade, though. It was really risky. U.S. dollar, Japanese yen, this one's sort of coming back. We're up just a few bucks there, and these are all fake dollars. These are demo dollars just to show you how to execute the trades. But the crossover strategies are really trouble. When you get into flat type of environments on these short time frames, yeah, you could have got a pretty good one right there out of the saucy CAD. But since then, it's just been a train wreck after train wreck. So if you're trading crossover strategies, you got to sort of be a little bit astute on when to trade them. I mean, it's just, we wanted to get some trades down and really show you some action. But honestly, this is just whipsaw. It's tough. I feel like Jay Powell. He blamed everybody but himself. He blamed everybody but the Fed for what's going on financially in this country and globally. I mean, think about what he said today. He said, we saw all these supply shocks. We saw COVID. We saw tariffs. We saw the Iran war. We saw Russia-Ukraine. Yeah, but that's kind of your job, is to be able to navigate these external geopolitical events and sort of smooth out the ride. The problem that I have with Jerome Powell, and it's not a personal one, and believe me, I'm just some guy that's a trader, a trader out here in Montana. Believe me, I don't run in these circles. These guys are heavy hitters and they're honchos. And in a lot of ways, I have no business really questioning their expertise because they really are smart and they're on the inside and they get information that I don't get. All right. So we know that right off the bat. But what I will say is this: I cannot stand it when somebody sits there and tells me, well, the COVID and then the inflation, we wanted to control the inflation after COVID. Well, you were the reason for that inflation. When you went unlimited quantitative easing and urged the government to pump the money into the system at a breakneck rate with the disaster loans and shutting down the economy and doing all those things were all pretty much a function of the Fed and the monetary system. Unlimited quantitative easing has destroyed the housing market here in the United States. It's hyperinflated it, and now in some regions you're starting to see it crash, and in others you're not, and that's a function of 0 to 1% long-term loans. There was a time when I was offered $1 million home loan, and I sat there and I go, how can I ever qualify for that? You know, I'd make a nice living, but you're gonna front me $1 million at 2%, 2.5%. Well, the problem is they wrote a ton of that paper, and that all goes back to the Fed giving 0% to these banks, mortgage companies, yada, 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 pump the whole thing up. So his inability to take any responsibility for the inflation that came after the COVID-19 unlimited quantitative easing blows me away, and I have a real problem with him on that. But other than that, I mean, the supply shocks, yeah, I guess the tariffs caused a problem. Russia-Ukraine did cause a big problem with natural gas, and also agriculture was coming out of the Black Sea region there. And I understand that as well. Those things are completely out of his control. But that COVID situation, that was a situation that could have been handled a lot differently. The last thing I'm going to say, and there's no explanation for it, if the inflation was persistent and they're so responsible and they're so worried about inflation, the 0.5 point rate cut from 5.5% to 5% right before the election of 2024 is a head scratcher. Because if you look at every single chart, and we'll do this tomorrow just briefly, every single chart shows that when you cut that by 0.5 point, since that fall of 2024, you started to see inflation really be a problem again in 2025. And that we could say that it really goes back to that 0.5 point cut. I don't really know what else to say about it other than Jay Powell was dealt a really difficult hand of cards. I don't think that any Fed chair out there has ever had to deal with a pandemic, multiple wars, a tariff shock, and honestly, the policies of the Trump administration, which are wildly unprecedented. Typically, it's business as usual. The bankers know what the government's going to do, and now the government, I mean, Trump, they're doing what they want to do, and it's up to everybody else to adjust. That's really different. So in a lot of ways, Jay Powell was dealt a really difficult hand. But I have to tell you that his biggest failure was COVID, and he would say it's probably his biggest success. Well, we avoided an economic catastrophe, and I said, yeah, but did you really? Not really. The bleeding, I contest that the bleeding still hasn't stopped from that 3-month period of monetary policy. I feel bad about it. I really do. I think that was really a terrible issue. Well, we won our Japanese yen trade, so that one panned out pretty good. All right, guys, I'm going to get off my soapbox. We've been going for over an hour. That press conference went way too long. There was no need for that. They just wanted everybody to get a question in, and they're trying to sort of placate the press corps. And I understand freedom of the press, and everybody needs to ask their questions, but there was absolutely no reason to go that long. If you guys stuck around and watched the entire thing, I really do appreciate it. We always appreciate you guys showing up and watching. We delivered a few winners, but there were some losers in there. And U.S. oil, as we speak, is exploding. 108.33. I guess we should have held our position, and we would have made a stack of cash. But this looks bad. I mean, this looks bad. Let me run a quick Google search and see if we've got anything hitting news wires right now. Trump threatens Iran to get smart soon. That's the one that seems to be driving. Man, this looks to me like you're going to see an end to the ceasefire. That's a big break. We're going towards 110. Energy prices are going to creep way high. One thing I do want to point out, though, before we sign off, the VIX is still severely depressed down there at 18.25. And also, take a look at your stocks. The NASDAQ is actually up on a day when WTI crude oil is up almost 9%. That correlation, that negative correlation, crude oil up, stocks down, it's not really holding anymore. It's changing. We are in a changing environment, and that tells us that our equity valuations not going trend day down in a big way. When you see WTI crude oil banging higher by 9%, 8.5% right now, when you don't see that inverse correlation anymore, that tells us that the markets are becoming, for lack of a better term, cool with higher energy prices. This dynamic is shifting so quickly. It's really a challenge. I'm not sure, as being an oil trader since 2011, I'm not sure I've ever seen anything remotely close to this. I mean, that's an 8.5% move, and your next level up's 110. It looks to me like we're going to 125 and testing that out a little bit. Oh boy, this is tough stuff, guys. This really is tough. I think tomorrow's session is going to be fascinating. Remember, the BOE gets involved tomorrow, so if you're trading the Great Britain pound, you better watch out. Be ready for that economic announcement from the Bank of England. I don't believe they're going to do anything with their interest rates. The Bank of Canada held firm today. The Bank of Japan held firm earlier, and the Fed held firm. I expect the same out of the BOE. I'm not sure that anybody's making any moves at all right now in this economic cycle, given the Iran war and also given what's happening here in the United States, for sure. All right, everybody, I think I'm going to go ahead and sign off here. Let me see. We had a question there from 512 Eli. If that's the goal, to get inflation lower, it was inevitable. To me, I disagree. I don't believe that they're serious at all about inflation, Eli. I don't believe that they're serious at all about restoring pricing stability because, I mean, just go with me on this, and the economists out there are going to scratch their heads and they're going to say I'm crazy or I'm not educated on it. But from my point of view, when I look at monetary policy, I understand that if you're going to shut the world down for COVID, and I know I'm still on this, but I'm on this because we haven't recovered. The recovery hasn't happened. Your stocks are higher. That's different. That's a function of inflation. But what we're seeing now is consumer confidence is down. We're going to the AI boom where productivity is probably going to go up and employment's going to really struggle. And we're in a situation where all that easy money that sort of took us a few rounds during the COVID shutdown, that's drying up, or it's dried up years ago, but the inflation remains. So if the inflation's there and all of a sudden the monetary policy is a little bit tighter, what happens to growth? There's no growth. So I'm really curious of what happens with the economic output here, not the output, but the GDP growth here of the next several quarters. I'm not sure that it'll be stable. I really don't know. We're going to have to wait and see. But the problem with pumping the money, unlimited quantitative easing, means that the central bank was going to all those regional Fed banks and they were giving them 0%, 0% or 1% or 0.5% or 0.25%. As much money as you guys need to make it work, let's make it work. And that's all great. So they did it, but there was no reciprocal. The idea was, if we don't do this, we're going to crash and we're going to go into a deep depression. So we're just going to pump the money into the markets. But there was no way to unwind it. We always talk about an exit plan. Their idea was, we're going to pump it and we're going to worry about pricing stability later. And the idea was, well, we're going to raise interest rates incrementally. And that way we're not going to get a big pullback. And then we're going to foster growth. And we're going to try to restore pricing stability over time. Hey, newsflash, man. This is 6 years later. All right, this is 2026. They did this in March of 2020. And you still can't get inflation remotely down. Prices are incredibly multifold higher than they were before COVID. So to anybody that says that they've restored pricing stability is nonsense. Sure, we've avoided the Weimar Republic and we're not seeing, the prices on our menus at the restaurant change in front of our eyes. Okay, that's fine. But go to the store, buy your groceries, multifold higher than they were in 2020. Go to the gas station, maybe they're a lot higher than during COVID, but that's different. Energy's different. But the other things, the staples, your rents, your homes, home prices, your travel expenses, things like hotels, things like eating out, meals, very difficult. Things like even car rentals, depending on where you go, can be very expensive. I am in complete disagreement with Jay Powell that they've done anything to restore pricing stability. The inflation is entrenched. These prices are never coming down. And that's sort of the reality that I've come full circle to in the last 24 months. Paul Volcker wasn't coming to save us with 20% interest rates and suffering through a short recession to restore the economy to what it needed to be sort of pre-COVID. Now we're just playing the inflation game. And as long as they're printing fiat currency and they can control inflation, maybe keep it under 3%, then they're going to call that a victory. But it's not a victory. It's not a victory. It just isn't. Prices are moving up exponentially. And honestly, the Trump administration, what they're going to do with Warsh, trying to cut interest rates and make growth, promote more growth and just get the economy hyperactive, it's a fool's errand because you're just going to grow and the inflation's going to get worse and worse and worse. Theoretically, we're going to be making more and more money, right? Well, yeah, some folks are and some folks aren't. Headed for a major catastrophe, but maybe it doesn't happen for another decade or 2 decades. How long can they play the shell game? That's really what we're talking about. We're talking about a shell game. In any case, it just is exactly right, Eli. The can just got kicked down the road. 100%. That's exactly what Jay Powell did today. He blamed everything that happened during his tenure, said we're in a pretty good position, and I'm going to stay on as a chairman, or not a chairman, but I'm gone. Yep, I'll be safe. It hasn't been easy. I have also know prices don't go back. Yeah, prices don't go down. We just want them to stay firm for a while, and they haven't been able to. Let me see, Calvin, but Shane, what could they have done? Not much, if you ask me. I agree, Calvin. And you say, what could they have done with COVID? It depends on what you think about the entire pandemic. And I am sympathetic to the pandemic. It was a big change for everybody. The lockdowns were very real. The mortality rates were very real. Did it actually develop the way that the experts thought? And I don't think it did. But we do know this, is once they shut not necessarily the government, but once they shut the economy down and restricted commerce, everywhere from New York City, to Helena, Montana, where I was living at the time, they closed restaurants across the board. They closed down everything. And it was something that was unprecedented. I actually did a podcast during COVID and said the outcomes of this are probably going to be immeasurable, and we're not going to see them probably for a decade. We won't know what we did. And so in one respect, Calvin, you're probably right. What could they have done? I don't believe they should have went with the QE. I think we should have went into a recession. If we were going to shut everything down, the idea to try to promote and keep economic growth sort of stable as possible. We weren't just talking about warding off a big depression. That was the worst case scenario. They opened up the coffers and tried to foster economic growth during a period of relative lockdowns. So to me, and a lot of that came from the Trump administration. He was the president at the time, and he said, "Okay, is there any way that we can keep going economically through a lockdown?" Well, the Fed said, "Well, immediately we can put a bunch of money on the street, and that'll help. That'll shore things up." And then the administration said, "Okay, now let's just issue a bunch of loans. Let's put as much money as we can out of the treasuries out there to try to support everything." And what my point is it probably would have been better not to do that, or at least not to the degree that they did. I'm sorry, but now we're dealing with an entirely new economy, and the amount of wealth that has been lost from what I would call Main Street, folks like you and me, the purchasing power of our money, the value of our savings, relative to the cost of acquiring hard assets now, to me, it's incongruent. And I don't think that's ever coming back. So there you go. That's for sure. So, I mean, I hear you, Calvin, and you make a great point. You know, so the other side would say, okay, Shane, so you're not going to do anything and just let everything crash? And I would say, you know, maybe. Probably wouldn't have shut down. You know, that was my view at the time. I said, this shutdown is really risky. I don't know that the system can handle it. Our system's built on growth. And once you don't have growth and you shut everything down, man, then what happens? Well, you're in a position like we are today. You know, a steak costs $40 at the store. So that's for sure. Over in the How to Trade community, Ralph, did other developed countries do the same thing? Yeah, everybody did the same thing. They cut their interest rates down to nothing. They tried to support the populace as best they could. And the degree of the lockdowns and everything, it was just different no matter where you were. Here in Montana, it was not as bad as it was in a lot of places, like in New York City or like in San Francisco. They were much worse in the urban areas, whereas sort of in the rural environment, yeah, your favorite bars and restaurants were closed. I remember they did it on St. Paddy's Day. They did it on St. Paddy's Day 2020. And they closed all the bars there. And I was really shocked. I said, wow, those guys lost a lot of money. And then it just kept going. My point is this. It was worse in other nations, too. It was worse. Australia was a bad one. The lockdowns there were very bad. It's a head scratcher. I don't know that we need to go that way ever again, because it's like, did the benefits outweigh the risks? I don't know. I mean, sort of tell that to the next generation of folks coming up that are looking at being lifetime renters that are never going to be able to buy a house or buy land or anything like that. I genuinely don't know how this story ends, but I know Jay Powell panicked and he got scared, and that's why they cut interest rates to nothing. That's what I think. I think that the data sort of bears that out too. And it's easy to do this post-haste. You know, I remember 15 days to flatten the curve. I remember it. That's for sure. I remember a gallon of gas cost 99 cents. Yeah, I remember that. It's nice. It made society realize another way of living instead of being stuck in this 9-to-5 rat race. 100%, Eli. That's why, you know, the property values in house prices where I live here in Montana went through the roof. A lot of people realized they could work from home. And so now they just said, I'm going to move out to Montana and buy a place. Things here were cheap because nobody lived here, and now they're very expensive. So yeah, it changed everything. Let me see, Calvin. Gold price could see $8,000 on $8,000 on de-dollarization. Deutsche Bank projections by 2031. I think it's possible. I mean, I think if we rally and really break, if Warsh gets in there, if Warsh gets in as the Fed chair and goes aggressive, like I think he's going to go, I think it's going to be at the end of this year. But let's say he starts cutting interest rates by a half point a click. And all of a sudden, you see the dollar start coming down, which essentially is what the administration wants, because the weaker dollar is going to send the stocks through the roof. It's going to be easier to get money. Essentially, that's what it is. There's going to be more dollars out there, and that's going to make them worth not as much, right? Well, if that's the case, you could absolutely build a bullish look at gold. I've heard 12,000, to be honest with you, Calvin. I've heard 10, 12. But 8's possible. 8,000, I mean, that's staggering. 2031 is not that far away. I mean, we're in 2026. It's only 5 years. And I could see us breaking to 7,500 by the end of Q1 next year. It just depends on how the rate cuts start unfolding. But I got to tell you, it's going to be really tough to cut interest rates and sort of neuter the dollar when you're at war and you're looking at $108 crude oil. There's no question about it. All right, everybody, this has been a marathon live stream. I'm going to go ahead and sign off. I do appreciate you joining. Thank you for all the questions and the engagement. The dialogue's fantastic. We're going to be back tomorrow. I believe I'm going early tomorrow, if I'm not mistaken. Yeah, we're going to go ahead and go early tomorrow, right after that U.S. Open at about 10 a.m. Eastern. We're going to cover the BOE. We're going to recap that. We're going to look at GDP numbers are out tomorrow. I don't know that they're going to be great. Core PCE, we're going to look at those inflation figures, the latest inflation figures from the PCE, Personal Consumption Expenditure Index. And then we're also going to break down the fallout from this Fed. Remember, there's always a big reaction sort of surrounding the Fed. Today, we didn't really see it. Tomorrow, I'm guessing that we're going to see a little bit of bullish price action out of a lot of things. I don't know that it's going to be crude oil 2 days in a row, but wow, the game is changing. Tomorrow morning is going to be a lot of fun. So feel free to come on back. If you want any specific markets that you would like me to look at, go ahead and send them in. You can hit me up at howtotrade.com. You can also, I'm on X too, ShaneV_Trader. We put a lot of content out there as well. So that's a wrap for me. Long session. I got to tell you, that was one of the most boring Fed meetings of all time. I'm looking forward to when Warsh gets in there. We can try to get a read on this guy, and this will at least be a little bit intriguing and something that we can talk about. So remember, if you want to trade anything we talked about today or any of the ideas or strategies, go ahead and hit the Switch Markets website. You can go ahead to this site here, the Switch On newsletter, get our free weekly newsletter emailed to you directly, and that'll get you up and running with the week ahead. This week was a day late. We had some publishing issues, but it came in as a midweek brief. All right, guys, that's a wrap. Last day tomorrow. Absolutely right, Eli. We're going to be rolling into May here. May 1st, May Day is going to be on Friday, and it should be a lot of fun. I'm looking forward to it. But tomorrow, last day of April, typically see a lot of action, and boy, howdy. I mean, $108 crude oil. Oof, wow, unbelievable. All right, everybody, have a fantastic trading session. As always, trade the action well, and we'll talk soon. See ya.